Good morning. We will go ahead and call to order our Oklahoma City MAPS Investment and Operating Trust meeting for February 17th, 2025. Item 2 is approval of minutes from November 18th, 2024. They were included in your packet if you've had a chance to review. Any changes, modifications? Okay. Please cast your votes. Are you a yay, a nay? Oh, there we go. Okay.
The voting screen is blank.
How would you like to vote?
Yes.
Okay, thank you. Okay, the motion passes. Moving on to item 3A, receive general manager report for the period ending December 31st, 2024. Matt?
Good morning. I won't spend too much time on this. This is because most of this information will be presented again in our investment report and in our other calculations. But this is the report that I presented to the MAPS 4 Citizens Advisory Committee last week, just as they prepared, just so they're in the loop on what we're doing. I will note that on your screen, this is correct. We did have a Scrivener's error on the total column on the dollars amount above corpus in the original that was in your packet, but that's the correct version is up on the screen. And really, this is the exciting time when we are getting ready to, a little bit later, pick and see how much we're going to allocate for the fiscal year 2026 and move on. So I can answer any questions you might have.
Any questions for Matt? Okay, thank you.
I will say that the MAPS 4 Citizens Advisory Committee had great questions about this, and they were engaged on that, and so it was good to see the cross collaboration on that.
Good,
Yeah.
Thank you. Okay, moving on to item 3. Oh, I'm sorry, we need to receive that report, so we'll take a motion in a second. Keeping me in order here. Please cast your votes. Motion passes. Thank you. Moving on to item 3B, receive quarterly investment report for the period ending December 31st, 2024. Doug Anderson is here. Good morning.
Good morning, Madam Chairperson and trustees. First, we're going to go over the 1231 report, and then we'll go over a brief update. Last year was exciting in the markets, in the world. I'm driving, is that right? Okay. Let me make sure I get this. I'll go straight into the charts and graphs. I think it tells the story quicker. The upper right-hand side, as you look at the screen, is the quarterly performance. And one thing that was very apparent last year was that U.S. equities outperformed international equities and outperformed fixed income. So the blue columns on both of those charts, the top one is the quarter, fourth quarter of last year, and the 1 year is the full year period. You'll see that U.S. equities were up about 2%. For large caps, 2.5%, but then when you get down to mid caps and small caps, it was much smaller. The market's been led predominantly, sorry about that. The market's been led by very popular stocks, the Magnificent Seven, right? So that's your Amazon, Microsoft, Apple, NVIDIA, Meta, and Alphabet. I can't keep the names, they keep changing on me. But those are the ones that drove most of the market performance. They're huge companies, they're very cash rich, they have good earnings, and they are growing those earnings continuously, it appears. You can see in the middle of that top chart, those are international equities, the golden columns there. So the all country ex-US was down 7.6. EFA, which is the so-called developed markets, think Europe, Japan predominantly, down 8% on the quarter, and emerging markets down 8%. And a lot of that was due to dollar strength, right? These are returns translated back into US dollars. The dollar has been very strong. I think the dollar to euro is about at parity right now, 1, right? I remember in the past it's been below right after it came out where a dollar was worth more than a euro. But I also remember not too long ago where a euro or a dollar, the euro was $1.6, right? So there's been some real changes going on in that world. And I think that Europe is in a little bit of interesting spot right now. If you think about the biggest, most successful companies in the world, we're at a time where those companies are predominantly in the US and in Asia right now. The big companies other than banks, and there are some very large and powerful European banks, but they used to have a much stronger manufacturing presence in the world, and that has declined precipitously since COVID. So Europe or international stocks have not been great for in US dollar terms or in local currency terms either. Bonds had a very difficult quarter. You can see down about 3% across the board. And if you remember going into the third quarter of last year, it appeared that inflation had peaked and was going down. And the Federal Reserve saw slowing in the economy, so they cut rates 3 times in the fourth quarter. Remember, when they're cutting rates, that means they're encouraging economic growth. When they're raising rates, that they're fighting inflation, but it's a very narrow cone of success, I would say, on that. And so when the bond holders, bond market in itself, saw the Federal Reserve cutting rates when they thought it was too soon, they sold bonds, right? And so when the market sells bonds, that means that they think that the Federal Reserve is acting too quickly. Since that time, and there was a Fed meeting last week, the Federal Reserve Chair came out and said, we're not looking at cutting rates anymore for a while. We are about where we want to be. And if you think, just in the fourth quarter of last year, they were looking for 3 or 4 more interest rate cuts this year. Going into the meeting last week, they were expecting 2, one in September and one in December. And now the market expects there to be 1 interest rate cut this year, and that's in December. Now, the market and pundits are phenomenally bad at predicting this, but if you get the direction of what they're saying, is that economic growth is okay. We're still more worried about inflation. So it's atypical what happened in the fourth quarter. When the Federal Reserve cuts short-term interest rates, usually all rates go down. And that means that the market thinks they're acting reasonably. But when the Federal Reserve cuts rates and interest rates rise, and that's not just bonds, that's mortgages and other things that all of us have to deal with, that means that the bond market sort of rejected what the Fed was saying. Looking at the trailing 1 year, equities were the place to be. If you own those top 7 companies in the US, you had a phenomenal year. If you own the entire equity market, you did great during the year, but you do notice that there was a real dispersion between the S&P 500. Those are 500 of the largest companies in the United States, publicly traded. Mid caps were up 15, and small caps, that's the Russell 2000, were up 11.5. Although international equities were positive on the year, the fourth quarter really pulled that trailing year return down, and the same can be said for bonds. Bonds were on route for a yield and maybe plus type of return last year, but that fourth quarter really cut those results for the full year period. And then T-bills. That's cash, right? That's short-term interest rates, 5.3%. It looked like they were going to be beaten by longer maturity bonds last year, but in the end, the fourth quarter, T-bills had a positive return. The rest of the bond market was negative. So cash still has a place in portfolios, even after the Fed started cutting interest rates. Going on this slide shows you performance, growth dominant, right? The growth part of the market did very well last year. You can see for the quarter, value was negative. So that was, your insurance companies, your banks, materials providers, et cetera. Full year period, growth was phenomenal. The entire market was great, and even value was pretty good across the board, with double-digit returns for large cap value stocks. I'll briefly cover this slide. This is the market broken down by sector. So this is the index broken down by sector. So every company belongs in one of these sectors. Performance is shown for the quarter and the year. The quarter is the darker of the two columns in each pair. The 1 year is the lighter blue. You can see the name of the sectors going from top to bottom and the percentage of the index. So for instance, information technology is 29.7% of the index. It was up 35.9% during the entire year. So you multiplied those two together and you can see that was the biggest contributor. When your biggest sector is also one of the best performing sectors, that's going to be good for the entire market. I want to note one thing, and I know I've been, I won't say obsessed, but highly interested in energy, given the hyperscalers and all of the other things that are affecting energy generation, production, and transmission. But energy, the entire sector, is 3.5% of this index, right? Utilities is something that we talked about recently, 2.4%. And normally, utilities don't perform well when the market's being led by growth, but that's because energy produces, or the utility sector produces electricity, and electricity is highly in demand right now by the high tech, the hyperscalers, the AI. There's almost you could almost say that there's almost a land rush on for electricity right now. Companies are co-locating data centers right next to generation facilities, and you probably have heard that 3 Mile Island is being reopened. The nuclear reactor, the one that had the meltdown, they're reopening one of the reactors, not the one that melted down, of course. But Microsoft went to Constellation Energy, which owns it, and said, you know, we heard you're shutting down. We would like to buy all of the electricity you can produce, and we'll buy all of it for 20 years, and we'll pay double market rate for it. So that's how much that they're willing to pay for this. On the other side of that, Caterpillar, you know, they make every, you know, industrial materials and equipment. Microsoft also went to them just to see the spectrum that they're covering. They said, how many diesel generators can you sell us this year, right? Because they need backup power production at all of these facilities. And they said, how many diesel electricity generators can you sell us this year? And they gave them the number, and Microsoft said, fine, we'll take all of them. We'll take this year's production run, we'll take next year's production run, and we'll take the third-year production run, because we need that many backup generators for all of our AI facilities. And they're not just using them for backup, they're using them for supplementary power too. So that gives you an idea. They're going from diesel generators to nuclear power plants and everything in between. And Microsoft's AI budget this year is $80 billion. Amazon's is reportedly about $100 billion. So this is a massive, massive build out that I don't think people understand how many parts of the economy it's touching. Going into this, remember I said that utilities are 2.4% of the entire publicly traded market. So that's all of the big utilities, including the one right down the street, are part of that. And then energy, the entire energy sector, 3.5% of the index. So that's Exxon, that's Chevron, Schlumberger, all of those. 3.5% of the index. Apple is 6.6% of the index. So Apple is almost twice as large in market cap as all of the energy companies in the S&P 500. NVIDIA, which was not a household name 2.5 years ago, is now the second largest name in the index, and it was up 171% last year. So that gives you an idea that a lot of focus is going into this sector right now. Does it feel like, I'm going to date myself, does it feel like the internet bubble of 99 and 2000? Superficially, yes, but once you dig deeper, those companies were, a lot of them were not fully formed companies, Microsoft and Apple and NVIDIA are fully formed companies, and they're very cash rich. A lot of these internet companies, when the bubble burst, they really didn't have anything unique, and they had no resources. So what I'm going in depth to say is that there might be some volatility in these companies going forward, but I would not expect a full-on crash like we saw after 2000. We lived through that 2000, the aftermath of 2000. But these companies are different than the internet companies that came out then. I'm going to go briefly into bonds. I know it's not super exciting, but on the upper right-hand side, this is trailing market interest rates. So the one that we talk about the most is probably the Fed funds rate. That's the gray bar. You can see that going into the fourth quarter of last year, 3 interest rate cuts, and how the 10-year Treasury, which is the blue yield, you can see that it crossed over after the third cut. That means that the holders of the 10-year Treasury wanted more interest, even though the Fed was cutting interest rates. And you can see the yield curve is modestly upward sloping on the bottom chart here. But it is still inverted from about 1 month going out to 5 years. That's not normal. Inverted yield curve means that folks are expecting inflation in the out years, and it really, really does slow down capital formation in the overall market when you see it that way, because why would I risk my money on longer term debt when I can earn just as much at the short term and have no volatility associated with longer term bonds? So that's the market environment. We'll go into this slide. This is sort of the dashboard, the ultimate dashboard for this trust. The gray area is the paid in capital or the principal of the trust. You can see started in 2022. Additional funding in 23, 2 parts there, and the total paid in, or the principal, is $115 million. You can see that we actually have gains of $18 million, and that we have a buffer there, and Matthew just showed that a moment ago. The return since inception is 14.84. Let's not forget, when we're making long-term decisions here, what this felt like. This area right here, when we initially started out and we had a drawdown and we had to make some short-term changes to the portfolio. And I think that that was wise to do. We took risk off the table when there was a lot of uncertainty. We don't go down to the month or day, but right about here was where Russia invaded Ukraine and created significant uncertainty in the financial markets, and it took a while to clear up, but thankfully it did, and we were able to reallocate back into equities gradually, and this is where we are here. So not only have we had $18 million in gains, we've also had $8.5 million in income over that time. So their returns come from 2 different places or sources. Here's the allocation. Remember, I talked about 22. When we raised cash, right? And we raised cash and we took most of that from the green area, although some from equities, international equities, but we took most of it from fixed income. Said, why do we need to take duration risk when we can get the same yield with a safer instrument? So, and again, this is a tool that hasn't been available to us very often in the modern era because interest rates have been traditionally very low. Asset allocation, you can see here, doesn't change much, and it shouldn't change much, although we are holding $4 million in cash, $4.4 million, and that is in anticipation of distributions. If the interest rate market's structured as they are right now, we're not penalized for holding this in cash. And until the yield curve reinverts steeply, I think that this is a prudent course of action. A lot of endowments and foundations will hold 1, if not 2 years of expected cash flows in cash to buffer themselves from the inevitable volatility of markets. And this is the allocation. We have a fairly streamlined approach here. No illiquid assets, no private debt, private equity, anything like that, no hedge funds. because the entire portfolio is built somewhat as a hedge fund. We want to maximize long-term return, but also minimize near-term risk, and we have a few tools to do that. But as you go down this list, you see a lot of index funds. All the equity exposures are indexed. And at this time, I think that that's a fair way to invest the portfolio, low cost, cheap and easy market exposure. We have one core bond portfolio that's Dodge & Cox. It is the largest single allocation. It's relatively low risk. And then we have a high yield bond portfolio. Looking out over this year, one, I think it's time to review investment policy over the course of this year because we're not quite in the startup phase anymore, and it's time to revisit some of those assumptions. But two, I'll come back in a minute, we may be at the point where we can start thinking about investing in some of the other asset classes that are out there that are in the policy. I think those two discussions sort of can happen together at the same time, be more productive. And this is a chart here that shows the reason why. So all of these areas, this describes asset allocation. Each of these categories has a gray box, which is the policy ranges. So you're okay as long as you're within those ranges. And then each of those boxes has a line that bisects it in most cases. That is the target, the long-term target, and it has a arrow indicating where we are according in the current asset allocation. This is as of 12/31. So green arrows mean you're within policy guidelines. Red arrow means you're outside. The reason we're outside in fixed income is that we do not have allocations to alternatives and real estate. And that's something that I think we'll talk about this year. Decide whether we still want to have an alternatives allocation. And if so, start building into the plan of moving to that. But remember, we started funding this in 2022. This is still very much a startup. And I think startup, we took a fairly low risk approach to it. We still haven't paid out significant distributions. So I think that's really where we start to understand more of the long-term dynamics of this portfolio. Here is, for the quarter, I think the 1 year is more appropriate. So we show all of the allocations by the investments. We show market value at the beginning of the year, 120 distributions of 159,000 that came out of the, if I look, that's the Innovation Fund. That's all the distributions we made. This coming year, this distribution column, I expect, will be a lot busier. Management fees, these are all mutual funds, so we don't show management fees because it's deducted from the fund's value. Income and appreciation, about $13 million out of both of those, and you can see that income was positive for all of them. Appreciation was negative for Dodge & Cox, and that was in the fourth quarter, but that was less than the income. And then you'll see the breakdown by funds on here too. I'm going to go into performance briefly. 1 year return, 10.95. And that was with a negative 0.99% loss on the fourth quarter. So I have clients who were down noticeably more than 0.99 during the fourth quarter. But I think that the 1 year return is solid. If we go since inception, total funds 4.76. And that tells you that first year was pretty rough as we started out. So going down the list, equities did very well. Just like I said, these are all index portfolios. So the large cap, the S&P 500 25, the mid cap 15, and the small cap 14. Now remember that the market leadership changes, and we're in a period, sort of an extended period, where large caps have done better. The other side of that coin is that they are pretty expensive. And expensive, when it becomes less expensive, we don't like that. And that's why we're diversified into the mid caps, the small caps, and internationals are particularly cheap right now versus US. We look at bonds. The Dodge & Cox fund was up 2.26 for the year, and then the high yield bonds were up 29. High yield is a euphemism. We used to call these junk bonds, but now it's much easier to call them high yield, more appealing. But again, all of these performed as we would expect. I think this is a good slide for us also. We have the return for this year, 10.95. We have the return for last year, 14.13. So that's 2 really good years back to back. And while we were not invested for the entire period of 2022, I think this tells a lesson. This was the worst year on record for stocks and bonds combined because they both went down. Typically, when stocks go down, bonds go up, but 2022 was an inflationary market that we really hadn't seen since the 1980s. That's a long time ago. So I'm going to go briefly to, I want to show, where did I go? Where is it? This slide. This is very important. This is investment management expenses. We're very cost conscious here. We have 2 actively managed portfolios. Those are the bond portfolios. Everything else is indexed. You have a $35 million portfolio. That's a Fidelity 500 index fund, and its estimated annual fee is $5,000 a year. That is the power of indexing. I think indexing has a great power for institutional investors. I think that until we get much larger and we can add significant value, indexing is the way to go on equities. I think bonds, you can beat the index without taking too much additional risk. And there are no organizational issues that are material with any of these groups. We are watching, you'll notice that we have 1 Fidelity index fund and, or 2 Fidelity index funds and 2 Vanguard funds. That's because those 2 are in a bit of a price war against each other. Last week, it was noted, or Vanguard came out that they reduced fees on some of their funds. So we're in the process of going through and seeing if it benefits us to switch from one to the other. But this is the only area of the market where price competition is actively going on. These are 2 enormous companies, and we can use that for our benefit from time to time. So happy to pause for any questions.
Any questions for Mr. Anderson?
I do have one question. Madam
Yes,
Chair.
please.
The fees seem kind of high for Dodge and Cox Income Fund.
Say again?
The fees seem kind of high for Dodge and Cox Income Fund, especially compared to the Fidelity Index Fund. What are we getting for that?
Okay, that's a great question. And I will show you what we are getting. This is what we're getting. Notice on the, so if we were to buy an index fund to replace Dodge and Cox to do what they do, the return here would be the gray dot. The blue dot is Dodge and Cox. So over the last year, these are net of their fees also, Trustee Johnson. So over the last year, you received 2.26. The index was up 1% less than that after fees. And if you go out over the last 5 years, you actually earned 1.26% per year. That's not cumulative, that's annualized, while the index was down 0.33. Now, granted, Dodge and Cox was ranked in the top percentile. Because of that, we think the fee's worthwhile. And if you look year over year on this other side, you notice that performance is fairly, it's much more consistent on fixed income versus equities. And I could go into a painfully long discussion on why. But we believe that bond managers can more consistently outperform their benchmark index. And that's why we almost always elect for active management, even though it's more expensive. But the justification for the higher costs, and remember, index funds are price competitive. Their push of a button portfolio is configured, whereas this has much more human interaction with your portfolio. So that's why. You're welcome. Thank you for the question.
Other questions?
I have a question. Doug, I know that a lot of our growth in recent months have been due to the large cap, the S&P 500. Do you, in your crystal ball, do you anticipate some sort of pullback in the near future, or is it just kind of dependent on the impact of tariffs and that sort of thing?
Well, that's a good question, and we're in crystal ball territory, so that's always dangerous ground to tread. I will say that the world has seen tariffs and military conflicts and economic conflicts as much longer than we've had tradable markets in goods. We're investing in companies, and those companies have the ability to shift production from places where they are affected by tariffs and to places where they are not affected by tariffs. And you're seeing that happen already. One of the biggest semiconductor manufacturers outside of Intel, which is not having a great run right now, outside of Intel and NVIDIA, is a company called TSMC, Taiwan Semiconductor Manufacturing. They're based in Taiwan. And they make some of the highest quality chips out there as far as the technical specifications. But they're based in Taiwan. Last week, on their earnings call, they announced that they are in deep consideration of moving significant production to Arizona. And I think that they're not the only ones who will be doing that. Taiwan Semiconductor has sort of another issue overhanging it. They're based in Taiwan, and they are diversifying their production base for another reason other than getting away from tariffs. So you're seeing that. We're in an uncertain period, and I will say, when I go to my client meetings right now, I'm getting more questions of the nature of yours right now, which tells me that there's a lot going on. There's a lot to worry about. As far as the S&P pulling back, S&P and all other cap-weighted indexes have a very interesting feature to them that is sort of self-reinforcing, right? As long as NVIDIA, or pick whatever company you want, as long as NVIDIA is growing faster than the other companies in that index and getting larger by share price, it becomes a bigger part of that index. So right now, because of that, the Magnificent Seven are the biggest companies in the index because they've grown the fastest, right? And as you get bigger, your returns have a bigger impact on the returns of that. Now, the other side of that coin is that should Magnificent Seven fall out of favor, their share prices will drop and they will become smaller, but they'll be replaced by something else. And so I think it's an underappreciated, that's a bad pun, but I think it's an under-realized feature of these indexes is that it magnifies the positive performers and I won't say minimize, but it decreases the impact of companies whose share prices are going down. There have been several regimes over my observation of the markets. If you go back far enough, you remember, I'll call this back, energy is 3.5% of the index. There was a time, admittedly a long time ago, that energy was the largest sector in the index. There was a time that banks and financials, pre-2008, 2009, they were the biggest sector in the index. But it's really, in a way, it harnesses the best performers in the marketplace, and it sort of, it reinforces its own strength. It is a virtuous loop. the way that happens. So will technology always be this important? Probably not, but something new will come along. And I think that one of the things that really struck me was when the Chinese DeepSeek AI came out. I mean, it was a shockwave through the markets. I mean, you could literally feel it because this company, there's a hedge fund that produced it. I don't know if you know that, Chinese hedge fund. But they allegedly said better, faster, quicker. We don't need any of the new chips. In fact, they're not allowed to have the chips by US export law, but they had them anyway. But the deeper, more people understood it, it's not quite what it was initially announced to be. It is significantly more expensive than they announced it. But what I'm saying is that we're not investing in tariffs. We're not investing in trade policies or whatever. We're investing in companies, and companies will learn how to deal with all of these issues. They'll get some help from governments from time to time. They will have headwinds from governments from time to time. But I will say that the questions I've seen reflect some uncertainty on folks like you sitting on boards. But I also think that if we look past that uncertainty, there's usually good opportunities that can be capitalized on. Did that answer your question, or was that a...
No, that's fine. Thank you, Doug.
Thank you.
Great. Other questions? Okay. If not, take a motion in a second to receive the quarterly investment report. Please cast your votes. The motion passes. Thank you.
Thank
okay,
you.
And then just the January monthly.
Very well. I have good news for January. It was positive. And, you know, when I look at folks who say, well, positive January means 85% of the time the market will be positive for the entire year, I kind of look at that as astrology almost. You know, you can always make these connections, but that is, you know, more often than not, if the market will go for the full year, how it goes on January. January was positive. And it's also, I know the last 2 years have been very good for equities, but equity market strength is also serially correlated, which means that if you have a couple of good years, that third year is generally probably going to be good too. But looking at the market, January was positive. Value stocks did well. Smaller stocks did better in some cases, and international are actually pretty decent. Again, 1 month is not much time, but during the month you can see that market value went up to $136 million. No change in allocation, and the trailing 1 year return, 13.34, so a little bit better. Drop 1 month, put 1 month on. I will confess that I have a spreadsheet that updates approximate performance every day. It's about 13.8% as of last Friday, going back a year. So no significant change here, but do note that the since inception return has gone up to 5.42, right? And that's an important number for us here. We could talk a lot about quarters and years, but that since inception rate of return needs to be above 4% so we can distribute money to these projects.
Awesome. Fantastic. Okay. Any questions about the January? Okay.
I will, if I could
Yes,
just say
please.
something. It's nice to get these reports now. In the beginning, it was not. I dreaded coming to these meetings and looking
We'll
at
dread
these
them again.
reports and going, oh, we're below the corpus. But it's such a blessing now to see. We had to be patient,
Yes.
and we had to stick to our fundamentals, right?
Exactly.
So,
Yeah.
Exactly.
Absolutely.
We will have to rebalance this portfolio sometime. I will say that there's a lot of sophisticated investors say you have to be in private assets, and I think that those do have application, and they may have real application here because they're not as volatile, but we have to have the liquidity, and early on, we have to have liquidity, and I have to say that we moved pretty quickly to get out of bonds and into cash. And we weren't overly patient once we got there, because you remember we started allocating back relatively quickly. But yeah, that was a tough start. It really was. And Bob and Laura and I had another tough start like that many years ago. But I think there's lessons learned, right? We take advantage of what the market gives us.
Yeah, and I think we made some wise decisions during that time with your guidance, so thank you for that. So I take a motion and a second to receive the investment reports for November, December, and January. Please cast your votes. Perfect timing. Okay, motion passes. Thank you, Doug.
Thank you.
Okay, moving on to item 3D, ratify claims from November 13th, 2024 to January 7th, 2025. We have 4 claims totaling $13,684.36. Essentially, it's the auditing and custody bank service fees. Any questions? Okay, take a motion in a second. Oh, what happened? Where'd it go? Okay, the motion passes. Thank you. All right, moving on to item 3E, discussion of fiscal year 2026 fund distribution percentage. Matt, welcome back.
All right. Sean, if you could pull up the spending policy first, that's probably the best place to go as we are beginning these conversations. And you'll see by the goal of the spending policy is to spend at least 4% of the average market value of the investment portfolio over the last 12 quarters. And so if you remember, around this time last year, we had these conversations and we said, we have not had 12 quarters to work with. Well, as the calendar tends to do, it moved on, and look at us here. We are on the cusp of 12 calendar quarters, and so this is a much closer to what normal will look like. We said these first 2 years were going to be a little bit different, and they certainly have been, but now as we are getting through there, Sean, if you will now pull up the spreadsheet. This was, and can we get Doug's spreadsheet that has oh, we don't have that one here. So, and Doug is here. He can help me discuss this if we need to. But essentially, as you saw from the investment report, at 12/31, the total was $133.4 million. But if you take that average market value over the last 12 calendar quarters, the total of that average is $115,860,830. Notice that gap between the two, that's really what we're looking for. That's that buffer that's built in there because we don't want to have everything out there available to spend. It's there. And as the years go on, Doug's got a spreadsheet that looks at it. Every quarter, that amount's going to go up because you remember we were funded in 2 separate tranches, and then we had an additional allocation that came in a little bit later. So because of that, this is the amount that we're working with this year. The spending policy does save 4%, and just like last year, we have the ability to adjust that if we feel that it's necessary. But this is where the conversation at least needs to start. I will say that this is a dynamic spreadsheet, and so if you wanted to see what it looked like with, let's say, a 3% in there to see what that would look like, that is what we can do. So we can have those conversations here as well. Sean, if you'd put it back to 4. One of the phrases that Doug used when he discussed our cash balances was expected cash flows. And I think that really is also important to note. Last year, we approved a distribution percentage. It was in the $2.2 million range. The only amount that distribution that was taken was for the Innovation District of $159,000. So just because it's approved, it is up to the individual operators and projects if they actually take those. And so when we see if there is $4.6 million approved, that does not necessarily mean that 4.6 million is going to go out. In fact, it's almost guaranteed that it won't, because most of these projects are not in a place to take those yet. And each of the individual operators know that the longer they leave their funds in, the more they can take advantage of those investment returns. And so this is a dynamic conversation that happens within all these. But this is definitely our starting place, because this is what we would do once this is approved in the next item, whatever percentage that you as the trustees go with, that is what we would send to the individual projects and operators and have that conversation. And so this is where we would discuss this, Teresa.
Yes. Okay, so any comments, thoughts?
One of the questions that I have is when we look at these projects, how many are actually requesting funds? I know Innovation was the only one this year that requested the funds. But as we go into FY '26, I'd kind of like to know who would like to participate in this program to help support their operations.
And Matt, you may have some different intelligence than I do, but I think that I would project that Innovation will request theirs again, and probably Senior Wellness. And I know it has nothing to do with the percentage that we're talking about, but I know the streetlight project is going to start moving forward before too long. I think those are the only ones that I've heard of.
I would say the beautification as well.
Okay.
That would be one that has been inquiring about that, and I would expect to see them submit something this coming fiscal year.
It wouldn't surprise me if the Freedom Center requested, but I haven't heard that.
Perhaps it's helpful to put a projected distribution on this table.
There was a hesitancy for that. That was something that we discussed, because it is unknown at that point, but that is certainly something that we can do going forward with those. But the ones that we've listed are the ones that we've at least had the most discussion with at this point.
Or maybe even just available distribution rather than projected.
Okay, yeah. Okay, Jessica?
So is that not the figure that would be available?
Correct. That's
This is the figure that would be available
If-
for FY '26.
correct. If we determine that we're going to do the 4%, and I think
Okay.
that's what we need to make a decision on.
Got it.
So,
And we are at 10 quarters?
We are wrapping up. We should did we hit the 12th on?
Into this quarter?
So our initial funding date that we show.
Doug, you want to down?
The initial funding date that we show is 3/31 of 2022. Now do we consider that a quarter, or is that the start date? So there are some things, and I'm really thankful that they weren't able to pull up my spreadsheet, because it was not nearly as nicely done as this one. So there are a few of those things. We show our inception date as 4/1 of 2022, but we actually have a pre-invested market value as of 3/31.
So roughly we have 11 quarters instead of 12
Yes.
to meet our policy.
And remember that there are also, although we did go back and baseline everybody, right, last year, some of those have 8 quarters, and one of them I think has 7, right, because there were 2 additional fundings. So those are some of the issues that we were talking about last week.
But we kind of smoothed that out and made everything equal.
Yes.
And we don't even have to really worry about that now, right? Really, in theory, we've had 11 months, 11 quarters
Yes,
for everybody. We can look at it that way.
yes.
Everybody on equal footing, which I think we want to do.
right.
Yes, I think that's right. But again, our start date is 3/31. That was pre-investment. So I don't know if we consider that one of those quarters that we want to roll, or if we just call it a wash and say, we have 12
Yeah.
right now.
Okay, any other questions, comments?
So I guess remind me if only 3 might possibly use money this year, but 4% is approved. Where does the money go? Does it just sit there in cash?
It would remain invested according to policy, and especially with that, looking at the expected cash flow that could happen, what we would do is the treasurer's office would work with the investment consultant to see, do we have that 1 to 2 year cash balance available? Because I can tell you, some of the largest projects here that make up well over 50% of our allocations, more likely than not, are not going to take distributions at all this year. And so we feel like the 4.6 million isn't necessarily the number that we're working with, but it may include bringing some additional cash, adding to our cash balance and keep those invested. But luckily, as was discussed, our cash is still earning a pretty good rate at this point.
So if we go to this 4% here, it gets to the 4.6, let's go to Innovation Hall. They got $159,000, I believe, from us this year. I
Correct.
think that was on a report.
In fiscal year 25, yes.
Yes. And so they'll go from 159 to 842, up to $842,000 for FY26.
Now, Innovation District is one of the unique projects that does have separate sub
Three different-
projects within
Okay.
there, so that is not
Different
projects.
100%.
Okay.
And
But it was only a 2% that was
Right.
approved.
Correct.
Right, we did 2%, and then Innovation Hall's percentage of the 2%.
Okay.
Okay. Other discussion? Are we comfortable with the 4%?
I mean, I would say I'm comfortable with it because not all of it's going to get used. So
Okay. Is that,
And procedurally, we have this as a discussion item, and then there would be a motion to do the actual percentage. And once again, I'll thank the clerk's office and municipal counselor's office to work with us on that to make sure that we've got the item worded in such a way that we can have this flexibility.
okay, so we do. Oh, okay, got it. F, okay. So, any other discussion? Okay, if not, we'll move on to item 3F, resolution authorizing the distribution of funds for fiscal year 2026. I'd take a motion on the percentage.
We need to verbalize what the percent's going to be.
Okay. Somebody want to make a motion? I'll move. Make a motion that we authorize. Oh, I can't. Okay.
will make the motion
Okay.
that we authorize the distribution of 4%.
Okay. Do I have a second? Thank you. Please cast your votes. Sorry to make that confusing. I can't say. Okay, the motion passes. Great. Moving on to item 3G, we have a resolution to recognize and commend Laura A. Johnson for her work with City of Oklahoma City MAPS Investment and Operating Trust. And we'll ask the clerk to read that resolution.
Resolution recognizing and commending Laura A. Johnson for her service to the Oklahoma City MAPS Investment and Operating Trust. Whereas Laura joined the City of Oklahoma City in December of 1979, and whereas Laura served the City of Oklahoma City for 45 years and will retire as an Assistant City Clerk on March 14th, 2025. Or sorry, Assistant City Manager. Don't want to trade positions, right? Whereas Laura is one of the original members of the Oklahoma City MAPS Investment and Operating Trust, and whereas Laura helped establish and continually improve the Oklahoma City MAPS Investment and Operating Trust. Now therefore be it resolved by the trustees of the Oklahoma City MAPS Investment and Operating Trust that they do hereby recognize and commend Laura A. Johnson for her service and dedication to the Oklahoma City MAPS Investment and Operating Trust.
Okay, thank you. Okay. Take a motion in a second. Cast your votes. Laura, congratulations, and we so appreciate you.
Thank you, Madam Chair. I just want to say that while I appreciate the recognition, I never lose sight of the fact that while I'm serving on this trust and many other public bodies that I'm part of as a city employee, I do continue to collect a paycheck. And so the real MVPs here, the real MVPs, Jessica, Joanne, Bob, Kevin, and you, of course, Madam Chair. So much appreciation for the work that you all are willing to put into this, the service that you provide to our community, and the really great result that particularly the Ocmioc Trust is bringing for our community in a way that we've never even tried before. This really is a whole new experiment, and really so far I could not be more proud of the work that you all are doing, and I appreciate that so much.
Very humble comments, but we appreciate you very much and all the things that you've done for our city.
Thank
We
you.
miss you.
Thank you.
And I just want to
Yes.
echo what Teresa said. Laura, it's very kind of you to reflect the credit to others around you, and I think that goes to your heart. You're a true servant leader, and you are a true treasure for the Oklahoma City, state of Oklahoma, and you don't see too many people who put this many decades of service towards one institution these days, and for that you are to be commended, and I wish you all the best in your next chapter.
Thank you.
I'd like to make just a quick comment. I've had the pleasure of working with Laura for probably more years than we both like to admit. She's been definitely a mentor for me, and during my time with the city. And I think that a lot of folks are going to look at the return of our trust as of January at 17% and say that Laura really knew what she was doing. But I'd like to also congratulate you and welcome you into the retirement
Thank you.
group.
Thank
It's
you.
been a pleasure working with you,
March
Laura.
14th, big party, Civic Center Music Hall, 2 o'clock, yeah. All invited. You're all
love it.
invited.
Love it.
Thank you.
Okay. All right. Motion passes? All righty. So now, kind of,
I apologize. I have got to go do another public.
the work continues. Okay, moving on to item 4, comments from trustees, staff, and interested persons. Do we have anybody signed up to speak? Great. Any comments from staff? Okay. Any comments from trustees?
Teresa, I think I'd mentioned earlier, I don't know if I missed a meeting, but having possibly Mr. Todd come in to give an overview of all the projects of MAPS 4 might be helpful for this body, just so they understand about everything that's falling underneath the Innovation Hub. I really do think that would be beneficial, because both you and I are very understanding, and several others on this board, because we're so involved in the subcommittees and on the Citizens Advisory Board. But I really think everybody needs a strong picture of what that looks like, the implementation plan, and being a part of how this is moving forward. I just think it would be helpful.
No, I absolutely agree, and we've kind of talked about that, so we will get that on the calendar. Okay.
I'm still the boss of him.
Yes, there you go. Okay, any other comments from trustees? Okay, if not, just want to say thank you for coming, Doug, making the trip. Glad it was today and not tomorrow. And everybody be safe and stay warm, and we are adjourned.